What's up? Happy Friday. Today is FU Friday.
I love FU Friday.
Yeah. It's, if you're feeling a little bit fuddy, today's a good day because we get all the FUs out. JD Gagnon
you can be chilled for the weekend. You don't have to read news over the weekend because you come back on Monday, you listen to us.
That's right. Kiara, how you doing?
I'm good. You know what? For FU Friday, I almost did SBF. I know we've said FU to him before, but apparently he's been harassing journalists.
Yeah. He's
and then I was like, why should we give him all of our airtime? This is like giving, we're celebritizing the antagonist.
Yeah.
Right? We shouldn't do that.
We shouldn't even give him an outlet. FU SBF. That's what I said.
Anyway, that's not what we went with. We're going to talk about the banking crisis, which at first it's kind of like the American banking crisis. Do I care about that? You do. As a DeFi DGen, you super care about the American banking crisis, and we'll tell you why.
Yes.
That's it. That's all we're talking about. I don't know what else you want from me.
There's a lot of angles, but today we're saying FU to banking mismanagement. Whoop, whoop. Welcome back.
First of all, JD, what are you wearing?
Certora. Good friends at Certora, Muli and crew. Certora is a formal verification software, which is a fairly critical piece of smart contract and application security. We're good friends. They're a great company, doing amazing stuff. So
you're friends with everyone. You're so popular.
Well, sometimes we're friends. Sometimes I say we're friends, and all I did was steal merch from their booth. But in this case, we actually use Certora, and they're amazing. So,
are you going to tell us about your sick watch? I'm seeing the orange band.
Can you see it? Oh, just flapping around. Yeah. So today,
flapping around. Yeah.
Flapping around. I've been waiting for this watch. It's an Aventi watch. I've been waiting for it for 2.5 years, and it shows up in a box today that is absolutely obnoxiously huge.
I love it.
Inside the box comes a solid metal briefcase, and inside all of that, you get the watch.
Wait, how is this delivered?
UPS.
No way. Okay, so when you think about packaging, right? Yeah, sometimes when you order really expensive things, or I don't know, if you're trying to hide that you bought shoes from somebody, I don't know. Sometimes you can opt for discreet packaging. Right?
Oh yeah, it came in this box came in another bigger box with styrofoam that was just like the typical shipping.
Okay, I was thinking that for the valuable watch, that having just that box out there in the world would be really dangerous. So
yeah, I mean, this is my third Aventi, but I've been waiting for this one forever. So it's super interesting. It's called the Ghost. If anybody's interested, you can go check it out. Aventi. They're on Instagram. You can go to Aventi website. It's pretty cool. Anyways, all right.
I had to know. I wanted to know.
Yeah, it's pretty funny. I'm excited. My wife even took an unboxing video because she was so excited. So that's cool. Cute. Yeah.
Look at you guys bonding.
I know, it's so cute, isn't it?
Okay, JD, I have a question.
All right.
Is there a banking crisis on the horizon?
Yeah. And the only people that don't know that are ones that are living under a rock at the moment. And so maybe, I think we've talked about this a couple of times, but in the interest of this episode, maybe we'll kind of explain it at a very high, relatively non-technical level, just so people can kind of basically understand what the problem is. So there's a few reasons that this banking crisis has proliferated. Okay. And the governments and regulatory authorities globally are doing absolutely everything they can to keep a lid on this. But it's actually causing a lot of potential issues here in the very near term. So here's kind of the Coles notes on why it's happening, understanding that I'm not deeply involved in assessing these banks or their balance sheets. And neither is most of the people that deposit there, which is in and of itself the problem, is that even if you saw the balance sheet, could you identify what their risks actually are and if they have excessive risk? And the answer is probably not. Most people probably can't. Even regulators, this kind of went undiscussed until Signature, SVB, Silvergate, there's and now First Republic, which is the second largest banking failure in United States history. Somehow the media didn't pick that up very well. But I mean, that's a massive banking collapse. Effectively, the FDIC took ownership of the asset and is insuring all deposits, even if they weren't FDIC insured in the US, which is crazy, in my opinion. Okay, so how did this all happen? So a bunch of years ago, when we went off the gold standard, we went to this beautiful thing that is now causing us more pain than we can imagine, and that is fractional reserve banking and central banks having the ability to effectively print money into oblivion. So we have, 33 trillion in the US in federal debt. That's insane. It's like it's over 100% of GDP, which is generally the measuring stick of when things start to go sideways. Okay. So what that means is that when you deposit dollars in a bank, the bank can do a whole bunch of things with it. They can use those assets to then lend out multiples of that value. So you deposit $1, the theoretical limit currently is 12x. So they can lend out $12 using your $1 as their reserve. Okay. Now it used to be 20 up until 2008, and they reduced it to 12, which is better than 20, but still a challenge. So what happens is they lend out this money and they make the interest effectively on all of those loans. That's where the banking profits come from. And they turn around and invest your money in what's supposed to be short-term, relatively secure investments to try to get some yield, which then they pass part of it onto you. The shame here is that your money makes them 12x multiples of a much higher interest rate, and they pay you like 0.5%. Okay. That's important to note. I'll come back to that in a second. So if you look back during COVID, when the government was trying to find ways to get money into, they were trying to get money out of the ecosystem once they put too much money into it. So they put way too much money in by printing. And then they're saying, hey, all you banks, you should buy US treasuries, because when you buy a US treasury, that's taking money out of this money supply and investing in a US asset, which shores up the Fed's balance sheet. Okay. So all of these banks are going, oh, well, okay, if the Fed is telling us to buy treasuries, I guess we have to assume that it's great. What wasn't taken into consideration is the fact that all of this inflation was going to cause a necessity to increase interest rates, the Fed rates, which is what we've seen very, very aggressively over the last little bit. Why is this a problem? Well, treasuries, US treasuries, have a duration. They have a time period that you have to hold them for. Or there's a secondary market and you can sell them. But if, let's say, a treasury was granted at 2% yield, but now you could buy a new treasury at 5% yield, I'm not willing to pay dollar for dollar for a 2% yield product on a secondary market. I want a steep discount. Okay. So now all of these balance sheets, they've had to write down the value of their treasuries. That's a problem, because now all of a sudden they don't have your $1 anymore. If they had to liquidate everything, they've maybe got 60, 70 cents on the dollar, something like that. Okay. That's part two of the problem. Now, coming back to part one, why this is important. Another fatal flaw that the banking system made via greed, in my opinion, is that instead of just paying depositors an increasing rate that is somewhat representative of the rate that the bank is earning on your money, they didn't increase yields on savings accounts and checking accounts at all. So you're still getting like a 0.25 point per year at best through most of your core banking products. So depositors are saying, whoa, wait a second. Inflation's going bananas. Interest rates are going bananas. I'm earning nothing on these deposits. There's many other, I can go myself and buy T-bills, with a year or two duration. Yes, it's not a deposit account, but they're not going to hold any excess. So they say, hey, let's start withdrawing some money out of the bank. And the banks go, oh shit. Now, not only are they withdrawing money, we can't cover these. We don't have enough cash. The only option is sell all these T-bills at a discount, not have enough cash, or start calling loans for the 12 to 1 dollars that are out in the marketplace. As you can imagine, this causes well, a bank run essentially. And as soon as
I've got two really quick stats about that.
Okay, let's do it.
Just so that I don't have to throw them up later. But half of America's banks are insolvent, approximately. So over 2,000 banks have assets worth less than their liabilities. Yeah. And in that same kind of vein, if half of the uninsured savers withdrew all of their assets, just all of them, 186 banks would be at risk, aka close. Like,
yeah. And so that's what happened with SVB. That's what happened with First Republic. That's what happened with Silvergate, and Signature was slightly different. But anyways, so there's who's to blame for this? Who are we saying F you to? Well, I mean, corporate governance at the banking level, like F you to all of them, because this is like pure negligent mismanagement, in my opinion. F you to the Fed for jacking interest rates so fast. F you to Biden and co. for, and to a certain extent, Trump, actually, for inflating the currency like crazy by just printing money in ways that we've not even, like, it's orders of magnitude more money injected into the money supply than ever before in history. Like, it was something like $7 trillion in 2021, 22. Like, what? Probably much more than that. I don't know the exact numbers. Anyways, so F you to all those people. But lastly, F you to the regulators, because we have banking regulators that are equipped to look at these banks' balance sheets and try to identify some of these systemic risks before they happen. And so, although I'm talking about this in the context of the US, this is a global problem because every country printed money. Every country, the banking system has a very similar problem. Okay. Anyways, so yeah, it's a pretty, it's interesting because it's like one of those things that we should all be talking about and no one is. It's like kind of this like weird, like maybe if we just ignore it, it'll go away. It's not going away. Like there's no way that this is
away. So also you say nobody's talking about it, but there's been a few studies done and sentiment studies, that kind of thing, study being maybe a loose term here, but Pew Research and Gallup and Gartner and so on and so forth have been doing sentiment as they always do. And this was amidst the banks closing in the last couple of months. So not all of the banks had already faced. I believe that this was before First Republic. But over half of Americans, on a scale of 1 through 5, essentially, over half of Americans don't trust the bank. Yeah. Which is great because at previous times, people are very trustworthy with banks, right? They put all of their money into the bank. They don't diversify their banking. On our episode with Ben talked about how you should not put all your money into one bank, right? Like this is something that the average person doesn't think that much about, right? But anyways, sentiment is about the same as during the 2008 financial crisis. So our sentiment is already lower than what it was mid-crisis in 2008, which is really interesting.
Yeah. Imagine you had like a giant hole in the hull of a boat and you put like tape on the outside of it and maybe the tape is like underwater tape. So it's like sticky for like a minute before the water starts pouring in. That's kind of what's happened here. Like, so that sentiment happened during the first couple of banks. The only response that regulators, FDIC could say, or the federal government could do is say, we're going to insure all these deposits. Now, the reason that's somewhat acceptable is the deposits, like the bonds, if held to maturity, you get the money back, the T-bills, you get the money back, plus you get whatever low interest yield that you were promised. It's just a time mismatch. That's the problem, is these treasuries, if you have to sell them today, are worth a hell of a lot less than if you just hold them till the end of the term. Okay. So what the federal government is effectively doing when these banks collapse and they're insuring all deposits is they're just taking ownership of the T-bills. They're going to, put up the money in the short term. They'll get the money back in the long term. Fine. The problem with that is that doesn't actually fix the problem. It just is a Band-Aid, so to speak, to try to get people not to pull their money out of the banks. But with social media, the proliferation of social media, even so much more so than the 2008, 2009 crisis. Like as soon as anybody gets a whiff that one of these banks are in trouble, everybody knows about it. Yeah. And so, I mean, it's just, it's a really complicated situation that could have, should have, and needs to be avoided in the future. The problem is, I don't think there's a way to escape it right now. I don't think there's anything we can possibly do to fix it. Go ahead.
Warren Buffett agrees with you in saying F you to banking leadership. just for the record, you and Warren Buffett, you're peas in a pod today on this topic.
not all that often. The thing is, Warren Buffett, of course, one of the smartest people in the world at identifying trends and risks and so on. I don't always agree with everything Warren Buffett has to say, obviously, but he's a genius. So, and he's got a track record that spans many decades. So anyways, very smart guy. I'm happy that today we agree. But there's pretty much anybody that has any understanding of how banking works and the systemic risks globally is sounding the alarms here. Like, this is a big, big, big problem.
Absolutely. But the thing that's interesting with Warren Buffett in this particular article, I didn't watch the whole interview. Context is everything, right? So yes, Warren Buffett agrees with JD. Banking leadership is at fault, right? Yes. And Warren Buffett is saying that we should have consequences for their malactions because it is impacting people's security. It's impacting people's livelihood. It's impacting the American economy and then by ways the global economy. And so they should be punished and have consequences. But this kind of leads us to who's in charge, who's regulating, and should we really be saying a big F you to those regulators, right? Because we've seen this before. We know that this happens.
Yeah. So we should, I think I said that earlier. We should be saying F you to the regulators because, well, for a few reasons. Number one, the regulators are the only people arguably the only people that have meaningful resources to be able to watch and monitor this on a regular basis. They can also ask for information from the banks that the average person can't. Mm-hmm. So, I mean, my opinion, obviously, on this is that the regulators are somewhat at fault. The bank's mismanagement, their executive teams, senior leadership teams, in some cases, shareholders are being penalized by when these banks collapse, the shareholders get nothing. So they're all losing their investment also. I think the hope there is by penalizing some people, obviously you have to have a carrot and a stick. Mm-hmm. Generally, you can't, be successful without either. Right now, we kind of, for white collar issues, like we don't really have a stick. We have like this weird enforcement thing where it's like cash to a company, but no one ever has to face the music for anything that they had a material part in, it seems, in the business and banking sector, including securities and including crypto. SBF is maybe one of the few examples publicly where a person is being singled out as, being negligent and mm-hmm. fraudulent. And I think that's important. Something has to happen here so that people, if you don't enforce laws and if you don't penalize this malicious activity, then it's going to keep happening. People are going to keep doing it because there's no disincentive to do so. So anyways, I'm pretty fired up about this because I think it's ridiculous. And as you said, there is some sentiment analysis and there was a lot of really, really good op-eds and really good reporting on this, but it's not being syndicated. Yeah. Like it's one of those things that everybody's, again, as I said, it's kind of like, well, if we don't talk about it, maybe it'll just go away.
Well, I don't. The other big thing about this is when you read these headlines, if you go out of your way to find it, because it's not in our primary news sources, the concept is the American banking crisis will threaten the global economy. I'm not here to tell you that it's not going to threaten the global economy, but we should think about how it impacts the global economy. What's the economic impact? What's the regional impact? How are different countries going to have to coordinate and so on and so forth? But my real query here is about the term threaten. If we want to use a critical thinking lens about threaten, what's really being threatened is America.
Right.
Because as you talked about yesterday with Christine, BRICS exists. And if anything, this will just quicken the de-dollarization, right?
I mean, it could. What I think is going to happen, like, again, this isn't so much, in my opinion, again, I'm not a expert on this or PhD in this or anything, but in my opinion, it's not so much that what the collapses in the US cause further collapses globally. My point is the same reasons that the entire US banking system is at risk exist in other countries also. They're all at risk for the same reasons. Now, to your point, where this maybe accelerates de-dollarization, in my opinion, is anytime you have massive economic uncertainty somewhere, people start looking for Hail Mary solutions to try to pull their way out of it. And so, although I don't think it's like well, there's a few ways to look at this. It could, if the banking system in the US has significant problems in the short term, it will put significant pressure on US dollar valuations and the credit worthiness of the United States, and all the banks and foreign entities are going to start pulling money out. And it's a bit of a cascade. But the bigger risk here, I think, is just that all of a sudden, all these other countries and regions are going to go, holy shit, our banks are about to collapse. We better do something. What can we do to like try to shore up our economic strength in other areas? And one of those things might be, well, the US dollar looks like it might have some negative pressure on it. Maybe let's try to join BRICS, or let's try to do this, that, and the other thing. Everybody's in the crypto world.
Well, this is all we talk about diversification, right? We always talk about diversification as like my portfolio, your portfolio, a company portfolio, but countries have diversification of assets too, right?
Yeah. I mean, the US dollar and US treasuries have been the world's safe haven investment assets for the last century. So, I mean, that also changes if foreign governments aren't willing to invest in treasury bills or put money in US banks. That completely changes the financial capacity of the United States at a federal level also. So it's, I mean, all of this to say, like, this is a big problem. Like, this to me is probably the largest single risk we have as a global financial economy right now. Like, we're talking a lot about Taiwan and China, and we're talking a lot about even de-dollarization. This is a far, far, far greater risk, in my opinion, than de-dollarization in the short term on its impacts to you and I. Mm-hmm. It's a big problem. One final thought on the global piece. I mean, BRICS. Well, I suppose like the Ukraine war and BRICS and all of this stuff is kind of all happening at the same time and feels like a lot of noise. I feel like that's a big distraction from the spiral that we're about to head into. And a lot of people globally are saying, "Oh, cool! All the money's going to flow into crypto." I don't know about that.
Okay, we're going to talk about that at the end.
Oh,
at the end. Yeah, we are. I promise we are. So Before we get into that, I want to talk about real estate. Because we're talking about banks and diversification and how much money they have and how much money they don't have. And commercial real estate in America, some people say it's going to crash and some people say don't friggin' worry about it.
Yeah, those people are great.
From a don't worry about it perspective, just to kind of throw that at you, hotels have the lowest vacancy rates that they've ever had in America. Right. So that's really interesting. And retail is also at a particularly low vacancy rate of 5.7% across America, which is pretty incredible, actually, especially if you consider like the Midwest and all of that kind of thing. And so they're saying that industrial, hotels, and retail are doing fine, but of course, downtown office buildings are not. And I read that a quarter of office loans in America have to be refinanced this upcoming year.
Yeah. So I have a few comments on that. The first one is retail is not that healthy. Especially if you look at sector by sector retail. So luxury retail is probably what they were reporting on. So your high end kind of luxury malls and shopping centers.
It said all retail, which like I don't see reflected in my local mall, but
or anywhere like that. We'd have to read the fine print on that one, but I don't believe that number at all. Especially when you go down to kind of your discount retailers, you go down to your like run-of-the-mill malls and stuff, that they're just not sustainable at their current rates of their current lease rates, right? It's not sustainable for a business to pay that amount of money for that amount of square footage when they can facilitate a lot of their activity online for free. Well, not free, but with much lower overhead than a physical retail space. Anyways, why is this this commercial real estate crash problematic? I'll explain. It's very connected throughout the entire U.S. economy. First, before we get into this, I'll preface this by saying I have a strong opinion on COVID. Okay, and I believe
I was trying to avoid controversial COVID.
It's coming
because we are now post COVID and we're seeing the after effects. So our opinions of what happened before don't really matter because it's about what's happening next, right?
So I guess what I'm saying is I feel like this is actually partially the point of COVID. This outcome is actually what was intended when this COVID thing got blown out of proportion. We don't need to get into my conspiracy theories on this. I don't think it's a conspiracy theory. I think it's actually rooted in fact now. But
whatever. I'm happy to do that episode, but
we'll do an episode on COVID. Yeah. Maybe not a go fund yourself, just a random video. But okay, so for whatever reason, everybody was told to stay home, and fear was hammered into our psyches globally, but especially in America. Okay, America, North America, globally it was a big thing, but in America and North America, it was like pretty crazy. New Zealand, Australia, Canada, same thing. Anyways, so what happens is real estate rental rates have been going up like crazy for the last decade, more than that, almost 2 decades. They've been going up like crazy. So every year, all of these building owners are able to either refinance, or every few years, they can refinance at a higher valuation, take more money out, which is what they all do. Generally take more money out of the equation, and this continues, right? So the value goes up, they take more money out based on the value of their property, they mortgage it effectively, they get loans based on the value of the real estate, based on the recurring revenue of rentals. Then COVID happens, and all of a sudden we've got, you know, somewhere between 30 and 40% nationally of commercial vacancy for office space and others. And that's a big problem. If you're a building owner, you're going from oversubscription and you can charge exorbitant renewals and all this crap to all of a sudden no one's renewing. And even the people that do renew are downsizing their lease. They're going half the size, a third the size, a quarter the size. And a lot of businesses, roughly 10,000 in the United States, went completely out of business during COVID, and probably endless amounts since then. So this is not a regional problem. This is not isolated to Silicon Valley or San Francisco. It's everywhere. Why is this a problem? Well, as we can imagine, most of these buildings are not held by individuals. Most of the buildings are held by real estate investment trusts, REITs. And a lot of the debt is held by hedge funds and pension funds and so on. So it's not even that the debt is in banks, although the banks are still somewhat involved and on the hook for this. A lot of those mortgages have been repackaged as mortgage-backed securities in bundles and sold to hedge funds and pension funds and all these large institutional investors. This is a problem because almost all of these buildings, when they come up for refinance, are going to be underwater. And so if you're a bank underwriting the new loan, you're not going to bail out the old loan and take all the risk on yourself. So these banks which are generally and largely regional banks that finance all this stuff. It's like smaller credit unions and so on that finance all these things. The large banks just stay away from it because it's such a big problem. But anyways, so all of a sudden, all these places are now underwater. Real estate investment trusts have to write down the value of their assets. If they can't refinance, it goes into bankruptcy. Like all of a sudden they're going to be holding these properties on their balance sheet because they will have probably assumed them as the main creditors, but they can't even sell them for what they're owed. So it's like this huge problem where, how does this affect the little guy? It's this huge problem where the people that the vast majority of their retirement savings is in real estate investment trusts, is in these huge funds, that pension funds and so on, and mutual funds that hold these debts. It's a huge problem. This is another massive problem for the economy in America, period, and globally, really. So I say F you also to those guys for increasing rates at such a crazy rate, continuously financing greater and greater valuations on these buildings with really no risk. I mean, I'm sure there's what they thought was good risk management, but now in hindsight, which is always clear, it's kind of obvious to most that this is a bloody disaster. Anyways, so
I think we should actually have maybe a full episode or a JD and Kiera special that's not GFU RBL related about commercial real estate and COVID, because some of my background is also in urban planning and public engagement and what have you. And it's not very transparent. There's a lot of double standards, and it's not going the way people expect it, which provides substantial instability, a lot of fear, uncertainty, and doubt. And that's why we're here. But what I'm hearing is that we don't trust the banks. We don't trust real estate. We want to diversify, but we don't want to diversify in banks or real estate. And that's where people believe that DeFi is going to blow the holy heck up. So Maple Finance CEO was quoted saying that it'll be 100x within the next 10 years. I don't know how we're reaching these sorts of blatant statements, but you said earlier that you don't think people will be pushed towards blockchain finance. And, not everyone agrees with you. Why do you think that people are going to remain in their little bubble?
Shout out to Sid from Maple. I had dinner with him a few nights ago, Tuesday night. Smart dude, very smart dude. And he has got very deep experience in TradFi. So we cannot overlook his opinion. I think I'm a little bit less bullish on this because I just don't think that the regulatory environment is acceptable currently globally for institutions, which are really where all the liquidity movements are. Yes, there is some retail assets that move around, but the vast majority of that is on the back of institutional recommendations. And it's just the environment is not acceptable for institutions to participate, as is evidenced by what we were talking about yesterday. Jane Street pulling out of US and North American operations, Jump talking about significantly downsizing, if not completely moving their entire operation out of the US. Like, this is not what is required for people to start meaningfully participating in DeFi and assuming that blockchain-based banks and blockchain-based investment products and structured products like Maple and others are a viable alternative. Couple that with the fact that, as evidenced by Pepe, I'm not a fan of meme coins, but that shit is what's catching all the news right now. And that is an absolute smear and stain on the reputation of the space. And I understand why people love the crypto casino, but way more people lose money than make money on these things. And it just looks horrible. The narratives that are shared with the real world look horrible. So anyways, I think at some point in the future, and maybe that's where Sid's going. He said 10 years, right? 100x in 10 years. We will have some regulation by then. I'm just not sure that.
So optimistic.
Well, we should have regulation by then, and we should have some certainty. And then by then, I think the space will mature. So I do agree with Sid in many ways. I think where I don't agree is that everybody's saying that they're assuming that with de-dollarization potentially, and with this inflation problem and the banking crisis and real estate crisis, that people are going to flood money into crypto in this bull cycle. It's going to cause a new bull cycle. No, it's not. I'm pretty willing to stand by that. I don't think we're going to see in 2023, 2024, unless we have like some clarity magically drop from the sky in the next month. I don't think we're going to see that. So a little funny for me today, but I think I'm trying to be pragmatic and realistic here. It was pretty FU this week. I know I talked way too much today, but I was fired up about this when.
No, this was your FU episode. I had a pretty blasé week. I don't have a pulse on the FU, and I built this for you.
I was ready to FU anybody that would listen today. So, but anyways, we've got you covered. So we'll be back Monday, 12:30 Eastern, same place.
Actually, Monday we're going to start Twitter Spaces.
Yeah, we're going to start streaming to Twitter Spaces too. Yeah. It's exciting. I forgot about that.
It is exciting.
Yeah. So in the interim, help us, set the alarm bells if you're watching on YouTube, or if you're watching on Twitter, bookmark, like, share, do all that kind of shit. I don't know how to use Twitch. I know we're on Twitch. I don't know how to use it. So do whatever has to happen there so that you get notified. But help us share the love. Touch some grass this weekend. Spend some time with your family. Don't stress too much about this stuff. We'll fill you in on Monday. Kiara, go fudge yourself.
Go fudge yourself, JD.